Does take us to our talk of the tape. The bull market's next move. Let's ask our experts where stocks are likely to go. Adam Parker, founder and CEO of Trivariate Research. Stephanie Link, chief investment strategist and portfolio manager with Hightower. And Lori Calvasina, head of equity strategy at RBC. Steph and Adam are CNBC contributors. Welcome, everybody. Lori Calvasina, I'll begin with you. You have a target of 6,600 on the S&P 500 for this year. 10%. I guess we take that. Why just that?
Well, look, valuation is a pressure point, right? And valuations are not an end-all, be-all, but I do think it's going to be difficult to really get a whole lot of multiple expansion out of this market going forward. Now, that doesn't mean multiples necessarily need to collapse, but I do have a hard time making the math work too much better than that 6,600, and frankly, even a little bit lower than that when I'm looking purely at my valuation model. I can get to those kinds of numbers and even a little bit higher on other models, but valuation is a problem.
What do you think, Adam? On a day where Jamie Dimon says of the market, I think asset prices are kind of inflated by any measure. What do you think?
Well, he did say that 30 and 50% ago. I mean, right? I mean, he hated the market the last 2 years.
He talked about hurricanes and things
right?
Like
I'm saying we're all right, we're all wrong.
Been a little sour.
But his stock's been a monster relative to what he himself thought.
But is that more relevant today than anything he would have said then? I mean, we have, if you look at the market multiple, we're at, what, 22 times forward on the S&P? The 10-year average is 18.3.
As usual, what Lori says is totally sensible. History dictates valuations at the upper end of the range. It's hard to sketch out multiple expansion. I think the bull case has less juice to it than it did a year ago because you don't have the Fed all in front of you. You may be getting closer to the end of that. We'll see. You don't have as much maybe in the form of fiscal stimulus from the U.S. with excess spending. We'll see. The China bull case seems less juicy. But you have two kind of still pretty bullish things out there. One is M&A. And you saw in December, and you've seen even this month, a lot of announcements on deals. Every lawyer and banker I know is busy. And that could create some valuation premium in certain parts of the market that could prop up, some lower valuations. And two is the AI stuff. And what I mean by that is not just whatever these headline numbers is and what they actually mean to translate to corporates, which is not necessarily the same thing, but just proof cases on productivity on the earnings front. Mm-hmm. If we get some of those, then the reason we all know the market probably isn't going to collapse is because we're not paying for 25 earnings or even 26. We're dreaming that there's something that's going to keep this going to 28, 29, 30 as we continue to get productivity from the biggest 100, 200, 300 companies. So we know today's valuation is high, but we don't know. We will debate, I guess, and we'll find out is it expensive on 28 or 29 earnings, and how much anticipatory will she be? But I took overtime from Steph, so I feel like I'm talking. Plenty of time. All right, good. Sorry. All right. No, I was excited, but maybe.
Oh.
Well, yeah.
What do you think?
Look, I think we have better than expected growth in terms of GDP. We've got good jobs, employment, wages are okay. You mentioned, Adam, productivity. That's going to help inflation. And at the same time, if any of the Trump policies work the way we think they will, then you're going to have lower commodity costs, maybe on the energy side, of course, as they drill, baby, drill. So I think you have better growth, a little bit less inflation. Maybe it stays firm, but that's okay because that leads to better than expected earnings. Right now, earnings are running at about 11% growth year over year. And what people are not talking about, and Scott, we talked about this actually at halftime this week, is that margins and margin expansion. I think it's underappreciated. I think you could see record margins this year, because of restructurings and productivity and pricing power. And companies have been getting more lean and more efficient. And so you add it all up. And I actually think, beginning of the year, I didn't think we were going to see 15% earnings growth. And I actually think that there's a very good shot that we will. And you do not need multiple expansion if you have earnings actually going higher.
That's exactly where I was going to go as you were talking, because you need earnings growth to be that good. Mm-hmm. Do you not? Because 100%. You already have a full multiple. How much more expansion can you possibly get on the market multiple? The real question is, can you get to your 15%, if not more?
100%. You're going to get it in technology. There's no question in my mind about that. AI, cyber, we talk about all the trends and the themes. Yes. But I think you're also seeing financials. We talk about the earnings growth and the surprises from 17 of the big banks over the last week and a half, and it's growing 26% year over year in financials. I think that you're going to see better than expected results in consumer discretionary, especially on the services side. So I think about the market overall, and so far this year, I've been surprised with the broadening out. So tech and comm services is running up about 2 to 3% year to date, 3 to 4% after today. But financials are up 6%, industrials are up 8%, energy is up 8%. So to me, the broadening out can continue because you're going to see better earnings growth from these other sectors as well.